It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
Oh,
someday I'll like that.
Today?
Maybe today. I can pretend.
What do you guys think? Is today the day, John?
Today could be the day. I hope so. I don't know. Maybe it's just me.
I like.
Welcome everybody. Thank you. Hope you guys
Hi.
all had a nice Thanksgiving break. The weather was mostly cooperative. Yesterday was a little wet.
Johnny G, Dr. Johnny G, weatherman and part-time real estate data analyst.
That's right.
Good job.
Full-time meteorologist, undercover.
Good morning, everybody. We're just messing around, having some fun. I hope you guys had a wonderful Thanksgiving holiday as well. It's post-holiday. It's December. It's December, Johnny. I mean, final month of the year.
I don't know
We
how
got to start doing.
happening to me.
We got to start doing predictive stuff now.
I know.
Everyone wants predictions in December.
Predictions, end of quarter, end of year. It's a heady time in between all the holiday activities. It's one of these things where time just compresses and you're just like, how am I going to get all this stuff done? And the next thing you know, it's January 3rd. You're like, wait, what? How did that happen?
I know. We only got a couple of good weeks, right? And then it's all over once you get to mid-December. But we're going to take advantage of it, people. We're going to take advantage of it. We got a lot of things to talk about today, guys. A lot of things to talk about. Let's start the show off properly. We expect a light show, tight community here. If you guys have questions, please put it right in that comment section right there. We're going to address them. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it's Monday, so you guys are going to get a little Macro Monday coming right at you. For those of you that are new to this show, we're going to start out in Manhattan real estate. There's some doings that we need to discuss. Doings, Johnny. Then we're going to pivot. Remember that friend scene with the couch going up the stairs? Pivot.
That was a great scene. Yeah.
we gotta get the 2 second
great duo.
Pivot.
Yeah.
Sorry. We're gonna go to some macro stuff over here. Talk about rates. Quick look at credit spreads. We're not going to spend more than 60 seconds on credit spreads. And then we'll talk about some macro stuff and circle back to Manhattan. And we'll try to do this in 30 minutes or less. We'd love to hear your comments, guys. There's a comment thing right there in YouTube. Just please ask your questions. Tell us what you see is going on out there. We rely on you to help us with this show. We don't want to just listen to myself or Johnny all the time. Okay?
Oh, that would be awful.
That'd be terrible. So let's just begin. There's some doings. Here. Let's talk about the doings, Johnny. I'm looking. 1 month, 30 day, guys, 30 days. So we're looking at November. This is basically November. Okay. This is basically November because we're in the new month right over here. We're at 797 for listing supply. We're at 767 for contract activity. Let me tell you guys what's going on here. Listing supply came in. Oh, where's my, you know what? Hold on a second. I got to go back. I got my new December ones. I got to go back to my November. So supply was supposed to come in at 991.
Right.
991 came in at 797. So it's light.
Big
time light. Yeah, big time light. I believe September was hot, right? September was hot, and then October was light, and November is big time light. Contract activity for November was supposed to be 850. We were doing great, guys. We had a big drop off, guys. Big. Look at this. Look at this drop off. Okay. Now, I want to explain what's going on. Again, we came in at 767. We're supposed to be at 850. I'm getting rid of this right here. December. Okay, here's my December. Let me just tell you what's going on, and then I'll explain what happened here. December's supposed to be at contract sign 774. If we're this light right now, it might be hard to beat that in December. Okay. For supply, that's 596. So again, everything goes on hold for the holidays. We knew this. We talked about it. We prepared for it. Hopefully you did too. And you're going into the holidays with a strategy. Now, John, we should talk about this right here. Okay.
Yeah, because it looks pretty scary when you just look at that. It's just like falling off a cliff.
It looks scary. Guys, this is daily contract signed. Like we're showing you bars of how many contracts were signed daily. Now, what happened was it's a 30-day moving window. Okay. So every day Okay, it moves up. Today's contract activity gets counted tomorrow once it's all done. And then day 30, that's in the measured day, gets phased out. So I want to show you guys something. Okay, I want to show you guys something. This is the last 60 days, 60, not 30, 60 days of contract activity. The liquidity chart that we're talking about right here, this liquidity chart right here, 767, that's 30-day. So I highlighted this big green box that shows 30-day contract activity. The reason it fell so much is because the back end, okay, go back 5-6 days ago, the back end had big bars in it. It was active. We were doing great. Like October was strong. We were doing a lot of contracts signed. So as time went on and those big bars, these 5 days phased out of this number, it was replaced by these 5 days coming in, which was so light for Thanksgiving. And that's why this went down like that.
Yeah. I mean, look, first of all, it was a late Thanksgiving. It's about as late as you could have it. So you had Thanksgiving on a Thursday, then Friday, Saturday, Sunday. That was the rest of November. And today's December 1st. So you don't have a couple of weekdays, a few weekdays in which you can have some more contract signs filter in. So if you think about November versus October, November usually starts slowing down. October is the peak month for fall. November is a little bit lower. So we're definitely seeing that. November is a little bit lower. But because of the way where Thanksgiving ended up this year and the contract activity, just sort of like big days come out and really nothing is replacing it. So it's like we have a big October, a weak November, and then hopefully this will set us up for a decent December, because I think you'll get some of what would have happened in November, like today, showing up in December's contract side. So
we'll see.
It works itself out. So look, long story short, I still think this market, I mean, despite this sort of statistical anomaly, this market still feels like it's doing okay. Now, if you look at the same contract signed monthly for Brooklyn, it's actually up seasonality wise. So it's above, it's down for the year, it's down for the month, but seasonality wise, actually over. So Manhattan actually is under. I think really it's more of a seasonality quirk than it is, just where Thanksgiving falls on the calendar quirk, than it is more to do with like demand just dried up.
Yeah, seasonality and holiday, and the fact that we were doing so hot right before it, in the weeks before it kind of thing, and ultimately those numbers get phased out. Okay, and that's what's going on. This really does reflect that we were coming from a high place, and then you got the holiday low, and you go boop, sharp. You just took a quick elevator down. Okay, quick elevator down. That's what's going on over there. Okay, wanted to explain it. That's where we're at. Questions, comments, concerns? No, we're good. We're good. All right, let's move on. Let's pivot.
Credit spreads. Who doesn't love credit spreads?
Everybody hates credit spreads, but we're going to do it anyway. Guys, credit spreads is our canary in the coal mine. If I click max on this chart, I like to do it when credit spreads goes up, widens, credit spreads widening, and this little index right here starts going to the right. That means internal economic credit stress is rising. It went crazy ballistic during the great financial crisis. It went spiked higher for the pandemic. We saw a little bit on Liberation Day, but at the end of the day, look at a 6-month chart. We're coming down on these credit spreads. So I don't see any crazy credit warning right now. That's all I see. Johnny?
Yeah, I think if you could zoom out to the year chart, I like to look at the year.
There you go.
can see what I like to talk about is you have that big spike. I say this every week. We have that big spike for Liberation Day and the tariffs came out, and then we've been working our way down, but it seems like that downtrend has been more or less broken. So while I still think we're in risk on mode because we're not spiking up, we're in a little bit more cautionary environment here. So,
well, crypto.
That being said,
crypto. The one space that was doing vertical for the longest time is some interesting stuff happening in the world of crypto right now, and Michael Saylor and strategy and Bitcoin and liquidations and wide bid-ask spread. This is great stuff, guys. Oh my God, this is all day trading stuff. It doesn't sound like it.
I don't envy the market. Like I look at, to me, the decline in Bitcoin and the amount of outstanding Bitcoin that MicroStrategy has, or Strategy, whatever they call themselves now. To me, that's an outlier risk. So to me, that proposes a bit of a credit risk in the market that I certainly am keeping an eye on, because you start having liquidations there. I don't know how much MicroStrategy has in credit. They might have, I'm sure they have several $1 billion that they have to pay back to somebody. And if Bitcoin's underwater, well, that could start rippling through. So it's one of those things to, kind of keep an eye on.
That's why you watch credit spreads, guys, because if there's a ripple through effect of some type of credit event with one company and that changes other companies and now private credit starting to get changed, you will see this blue line rise and you will see this go to the right, this index to the right. I always told you guys, look for 2 moves or more. So far, we haven't had that. So there's nothing really to worry about, but there's stuff going on in Wall Street right now that's unresolved doings in Wall Street. A lot of doings.
Yes. A lot of doings today. Going on. Look at that. More doings.
Let's go to the Fed.
Let's shift.
Yeah, let's shift to the Fed Fund Futures, guys. This is our interest rate portion of the program. Okay, guys, what you need to know is we are here, 375 to 500. Okay, right there. The next meeting date, we're getting closer, December 10th. It's only a week and a half away. As you get closer, these numbers start to get higher confidence. That's how this works. We've had some change. This has been flip-flopping back and forth for, let's get rid of that. For a little, how do I get rid of this? For a little while now. Okay, I know, right? I'm a little off. Flip-flopping back and forth between no cut and cut. Okay.
Yeah.
But now there's an 87% chance of a quarter point cut. I think that's going to happen. Originally, I didn't. Now it's getting close. It looks like it's going to happen.
Yeah, it's still penciled in. It's still a long ways away. It's still got a week. So you still have, anything can happen between now and then. But it's getting closer, and we're sort of in the pencil in territory. So all right, let's go with it. What's interesting to me is that second cut, which last week I think was around April. Now it's being pushed down to June. So it's getting a little bit more stable as you look forward, and that second cut's becoming a little bit less of a sure thing earlier in the year, and it might be more of a mid-year thing. If it all does happen at all.
And I think last week we talked about what we think neutral rate is, and I think we were talking about how it's somewhere in this range right over here that they could do 1 or 2 cuts, and that's normalization cuts, guys. Normalization cuts. It's not stimulative. If they start cutting down to this level, something bad's happening, and they're trying to stimulate. These are stimulate cuts over here. These are normalization cuts over here. And that's what's happening. We want normalization cuts, guys. We don't want stimulus cuts because then bad things are happening. Okay.
I think that's the Fed's tightrope right now is, do you stimulate or do you keep the rates slightly higher because you feel like there's might be inflation coming through the pipeline, in which case we'll talk about that. But it's
one cut.
A lot of doings here too, Noah. Doings all around.
This is what you guys need to know. 87.4% chance of a December 10th cut, quarter point cut. That looks like it's baked in the cake. Rates have been going down recently. Originally, they went up, and then they went down. They took it all back. Here, I'll show it to you. Here it is. See that right there? See that right there? They originally went up, no cut, and then they said, all right, cut. And now they went back down. That's what's going on over here. Next cut, as Johnny says, June. But that's way too far out, and that's way too low confidence. So who the heck knows what's going to happen? I'm not even looking at any of this stuff. It's way too far out. One cut.
I mean, basically, when I look at this, I have it's like 6 months of basically where we are. So, look, if the economy keeps on doing well, you could still see mortgage rates decline because that spread will come down because banks are a little bit more comfortable making these loans. So that could be hopefully a tailwind. But look, we're not in an interest rate easing cycle. That's the key. So we're sort of in this stability cycle right now as we wait for more and more data to kind of come in to give us a sense of all right, do we need the stimulus? Do we need higher rates to fight inflation? What is it we need right now, Noah? I don't know.
We do not need stimulus right now. I mean, there's cracks in the labor market, but you're going to risk an asset bubble, and the Fed's really good at blowing bubbles. Really, really good at blowing bubbles. Almost too good at blowing bubbles, and not seeing it until it's too late.
Well, that's the point. So do we need stimulus? No. Do we need higher rates to fight off inflation? Not yet. So we're sort of maintaining this middle road right now. So it can't go on forever. At some point, one of these two will emerge.
Rates are in a good place.
Great if we could.
Yeah, we'll see. To me, rates are in a good place. We're in a good place. You draw a line on this 1 year chart. We're at the lower tier, the lower sector of rates. So to me, rates have made a nice move down. Mm-hmm. The Fed made one cut. We're in a good place right now. I mean, not that it matters for Manhattan, right? I mean, Manhattan, what was it, 55, 60% all cash? But the lower end, of course, it could benefit from low rates. But I don't know how much lower you're getting from this point on. So we're in a good place. We made a nice move. Let's take it. Let's take the profits. Take it.
Yeah, look, I think this is, generally speaking, I think this is bullish for Manhattan and even Brooklyn activity, because I think you have mortgage rates sort of sitting in a stable area, not spiking one way or the other, just kind of going steady. And I think that the transmission effect is basically time, which is like, is it a good time to buy? Like, yeah, mortgage rates are coming down. All right, I'm going to wait. Well, they're not really coming down. They're kind of going stable. I think that sort of works its way into the idea like, okay, now's a good time to buy. And I think you saw that in the luxury market. I think it's working its way through to hopefully the under 2 million, the non-luxury market with mortgage rates sort of going sideways. Hopefully that's good. Hopefully people get back in and transaction volume is where it's at. So
yeah. This should not be surprising, guys. Mortgage purchase application index. This is the national housing thing from the Banking Association. It's there to tell you. I think I referenced this a couple times in past Macro Mondays. This is Macro Monday, right, guys? The point is, when you look at the national housing market, they have taken a hit since the whole pandemic boom kind of thing. It's been 3-4 years now of coming down from that top. And for the first time in a while, mortgage purchase applications are starting to pick up again. This is the first time in a while. That's the point of showing this. It's not crazy, but it's showing a little bit of green shoots that's going on. I don't know. Maybe it's the economy. Is the economy doing a little better? Retail? Black Friday?
Black Friday. That's the retail sales for Black Friday. That's the online version. So I don't think we have the in-store version yet, but online is just increasing and it's hitting a record number. So look, consumers are back. I mean,
consumers
they never
are
left.
spending.
They left in 21, I think, was a lower year, but there's reasons for that. And then we've kind of come all the way back. So look,
are people still waiting like around corners of brick and mortar to get in like at 5 a.m. Is that still happening or is that like past?
It still happens. I think there was a CNN article that had a line of people outside of a Target somewhere. So it's definitely still happening. I just don't think it's the phenomenon.
We're not tackling each other anymore.
15 years
we're not
ago.
tackling. There are those videos of people tackling each other to get in the last place.
Yeah, I think my big screen tackling days are done. But maybe if there's like, one of those massaging recliner chairs, I might tackle somebody for that. That sounds pretty good.
Brookstone. I sit in there every single day. When my wife goes in the mall, I'll catch me in Brookstone sleeping in that chair. Rubbing my ball in one of the massagers. I am that guy. All right, let's just go over a couple of inflation, economic activity kind of things. This is manufacturing side, guys, and this is where we're seeing some retail strong. Okay, retail strong.
Retail strong here, aka no stimulus needed.
Yeah, manufacturing and the ISM kind of orders continued weak. Like anything under 50, anything under 50 is contraction. Okay, it's not crazy, but it's been down. That's the point. This is what the Fed is grappling with. You got some economic weakness here. You got some economic strength over here. You look at inflation. Okay, this is the PPI, Producers Price Index. Okay, Producers Price Index. Target. You see where we are. We've come down a lot, but we're still above target. And I don't know, it's like, are they moving the target or did they have to act to get it down the target? I think they're thinking that there's enough restrictive policy in place. This could just naturally come down on its own. But that's the point, guys, is that we're in this economic battle of cracks over here in the labor market, retail strong, supply and manufacturing a little weak, PPI just a little bit sticky above target. And that's why the Fed can't do anything. Asset bubbles over here.
To because they'd like to. Frankly, they'd like to. I think they'd like to. And I think, I think there's, I think Trump is sort of signaling that he's got the next Fed chair lined up and it's a very dovish person. So the idea is that, look, if you've got, inflation at 2.7, I think the Fed would probably like to act on that, or rather not act to keep that sort of move it down, keep that downward motion going. But look, there's only a certain amount of time that you can have interest rates elevated from where they were before someone just decides to take action, and that's the battle they're fighting, right?
See, what the Fed's got to do is the Fed's got to take a lot of leading indicating data and try to think ahead of what may or may not happen. We talked about this, guys. We talked about how rents, okay, this is Boston rents in orange, wherever that is, and you got U.S. rents in black. We told you guys about this, that rents are going down. Owners equivalent rents is going down as a disinflationary element, not so much in Manhattan. I'm sure it's a different story in our little bubble, but rents going down is going to be a downwards push on inflationary elements because it's a big chunk of the inflation methodology. So
So this was a story out in Bloomberg over the weekend, and the idea is that the net is that rents in Boston are getting hit hard, and part of it has to do with the fact that there's reduced funding for a lot of the bio research facilities, and the economy is a little bit slower. So you have some colleges pulling back, the lack of H-1B visas. So it's just like it's a very Boston specific thing. And there's a couple takeaways here. Number one, what's happening in Boston is kind of mirroring what's happening overall, right? That black line, that US line, that housing price, rental price, year over year increase is working its way lower. To Noah's point, that feeds into the CPI, right? That's the owner equivalent rent. That's pushing down. That'll hopefully bring that 2.7 that we saw in the PPI, kind of hopefully bring those numbers down a bit. But the other thing I want to talk about just briefly is look how fast the rental market operates. And this is just a general thing, right? Boston was hovering around 3% year over year rents. That sort of like really fell down below zero. So it just it just evaporates. So the rental market moves much faster. It's very much a kind of a canary in the coal mine for real estate. So just something to keep an eye on here. And I would love to do it on the rental side here, but we're still short. We're still short some data after the Post-Fair Act. So hope it goes.
I would love to do it. I keep asking you for data, guys. Since the Fair Act in Manhattan, John, what is it down? Our RLS inventory is down like what?
75%. Yeah.
It's crazy.
So we don't really have a good window into it anymore. It was always a subset of the sample, but that's kind of gone. So instead of
makes sense
talking about where rents are based on a super tiny sample.
Yeah.
I hear think you. Outside.
Johnny, are you typing in there? It's too quiet. Johnny's upset that you guys are not coming.
I'm gonna send it.
I just want you guys to know that you're making Johnny upset.
I'm typing again.
Johnny Charts. Talk to him. Tell him something.
Shaming everyone.
Are you going to show an what is this? Are you going to show an updated strategizing for the upcoming seasonal shift chart? Probably should. I probably should.
It's a great idea. Thank you.
Yeah,
Susan.
I will work on that, Susan. Noted. You guys say some stuff to Johnny. I'll show one more chart while you guys talk to Johnny in the comments over there. Guys, this is
I feel so alone.
This is all right. UrbanDigs has its own price index. You know, I like to use. Let me just go to UrbanDigs for a second, guys. I like to use price per square foot resale condo. This is the new charts are in. I was going to go here anyway. This is a nice pivot to come back here. Resale condo price per square foot. This is my price action go-to chart for Manhattan. This basically, if you look at the orange line on this, that's the national housing price index. That's pricing for the national housing market. The blue line is pricing for urban housing markets across the country, right? So just look at the shape and look at the form and look at what we've done. Look at the pandemic. It's basically going down. Look at us. Okay, it's different. Very, very, very different. What's going on in our sector? You know, look at the national housing market. It's just a regional thing. It's a geographic dynamic that's going on steroids in the national housing market. And here we are in our little bubble, and you know we're suppressed, we're underperforming, but we're insulated. Guys, we're insulated. I'll say that again. We're suppressed. Go look at any other housing market that has done nada in 10 years. Okay, nada in 10 years. The national you go to the suburbs 10 years ago. We're up 100%. I mean, they're coming down now, but it's still much, much higher. So we're suppressed, yes, but we're also insulated. So what's going on out here and what's happening in some of these housing markets, it's just not hitting us. In fact, this is starting to come back up a little bit. If you notice that, guys, this downtrend, I just want to tell you, this price action downtrend represents a couple of things. It mostly represents the slow activity we had over the summer and the late summer before the September, October, early November pickup. Because if you sign contracts 3 weeks ago or in October, you're not closed yet. So this is starting to show the change. That's probably around August to September. And next couple of months, we're going to get September, October, November deals. And it's going to show us, we'll discover price-wise, how the recovery fared out, but we're probably higher right now.
Yeah, so that's a fantastic point. And we have this UrbanDigs advisor service. We basically help you price apartments and have conversations. A lot of times we have conversations with sellers about, well, hang on, wait a second. I bought this in 2015. What do you mean I'm going to break even? And this is one of the charts that we like to talk about. Is the idea that, or lose money, right? The idea is that, look, we really have we come up? Yeah, we've come up since the low, and like post-COVID, we've certainly made a run, but we've basically come back to where we were. So you're pretty much right around break even. Hopefully you can get there. You might not be. But if you go to that national chart, you can see such a huge move, that post-COVID recovery. I mean, look at that. It just spikes to record highs based on, artificially low interest rates. It spiked way up. We didn't have that. We just kind of kept going sideways. We recovered a lot of what we lost, and it's starting to give back a tiny bit. But you're right, no, we're sort of basing here. It's almost as if I tend to look at this chart from
here it comes.
It's a glass.
I know you so well. I know what you're thinking before you even say. Go ahead, finish it.
Well, it's like, to me, it's like a coiled spring. It's just like, it hasn't been doing much. Like the next move is going to pop up. That's kind of the way I see it. So I feel look,
Johnny.
Well, there've been a lot of headlines, and we actually, a few years ago, I want to say this is actually 2020, 2021. We did a look at, who's underwater, who's above water. And there are a lot of units that were selling, below their asking, below their previous sale price. And that's kind of continued. And I think Brown Harris, Jared Anton, I think they did a great piece a while. It's got a lot of traction about how it's been a lost decade for Manhattan real estate. And I've seen this.
Yeah, that's what a lost decade looks like. Yeah.
Yeah. And I almost get the feeling like, there's definitely been a lost decade. But if you could buy now at the same price as someone could have bought in 2015, like from a buying standpoint, this is a very interesting market to buy in, because I feel like you have you kind of know the downside, and you definitely have some upside here. So it's interesting.
There's relative value for sure. There's relative value for sure, because we have like these 10, 15 year cycles here in Manhattan, and then it just goes. Noam Newman thinks another couple more years. The sales market goes sideways for a couple of years. This is the rental market's time. And then 27, 28, that's when the sales market's going to wake up, kind of thing. That's an interesting thesis right over there. I don't know. There's so many local things happening in our markets. I don't know whenever we get investors back in, that's gonna change the game. That's when you'll see it, in my opinion. But I don't know when that's gonna start happening. So
and if you actually if you switch this chart to quarterly, which kind of takes away a lot of the noise.
So you want quarterly?
You can see. Yeah, and I think it's a little bit easier to see when you go back to max. You can kind of see how it's like it made that little crest earlier. Then we had that Liberation Day, kind of came down, but it's just hanging out here.
Yeah,
at a
interesting
higher low, I should say. So I feel like it's moving my hands here to sort of signify what I don't know how to say. This direction, up and to the right.
That's all you got to just go like that a little bit. That works. Everybody knows what this means. Okay.
I don't know.
Guys, I want to show you this one last chart before we end today. Let you guys go. The climate index updated for November as well. This fell hard. And I think it's because of this concept that we basically discussed of why did liquidity fall off a cliff? Let me show it to you again, guys. Why did this happen? Is something wrong with the data? No, it's not. Nothing with the data. You have a lot of activity in the back end of the window, no activity in the front end, and this no activity replaced that big activity. That's all that happened. That's all that happened here. So this chart, where is it? This chart now takes that into account for November. Excluding the last week and a half, 2 weeks, this was probably doing okay, but then it just plunged down. So we had a period of time, but the listing climate is still challenging, guys. So
I wouldn't be surprised. And to your point, I wouldn't be surprised to see that rebound in December, because I still think you have some contracts that were probably in the pipeline pre-Thanksgiving week that have been on hold. It'll probably be processed this week. And then you have that normal December activity. So I feel like you might have a little bit of a recovery there. So, but I still think this is a little bit of a whammy sort of own goal based on calendarosity.
It's champ over here. All right, guys, that's all I got. I don't see any comment. What up?
Oh, I gotta say, I want to
comments, guys.
I'm disappointed.
Very uninspired. Very unsatisfied. I'm very unsatisfied.
It's the post-Thanksgiving hangover. I think we all have it. I'll blame it on that.
I wanted to tell you guys a couple things. Tuesday, tomorrow, 11 o'clock, I'll be talking about, guys, bid reports for buyers, bid reports for I'm working on another session with a broker about creating comps reports for buyers. We'll do that later on. There's going to be one more session on Thursday. Okay. Liz Nelson and Molly Townsend, coaches, two top coaches. If you guys know them, they're awesome. Thursday, December 4th, 10 a.m. It's going to be put up here soon. We'll talk about top elements from real estate coaches. It's going to be fun. Okay. So hopefully I see that Tuesday and Thursday. Once we get to mid-December, it's going to slow down with classes and workshops.
Yeah,
okay.
It is. Yes. Hillary writes, I think we're all in shock over the unpredictability.
I love that
of everything.
comment.
I do
I
too.
love that
This
comment.
is like, I need
It's
like a third cup of
comment,
coffee
Hillary.
today just to stay on top of it.
Hillary, I mean, we just don't. Hold on a second. We just don't know what's going to happen, Hillary. And you know what? Quite frankly, it's a good time to be humble. Okay. What is the start of the sales market? Well, let's go take a look. Okay, guys, chart room. Let's take a look at optimal time to list. See, now the questions are coming in. Know what I'm saying? Okay. Optimal time to list. Guys, this is showing us monthly contract activity average for each month of the calendar year. So you could see our seasons. You could see December is one of the lower bars. January is one of the lower bars. Okay. We have to get through that. Ice, sleet, snow, cold, low transaction value. February is a transition month. March, April, May, and June. That's your top 4, guys. Top 4. 1, 2, 3, 4. Top 4 months is spring market. So that is your next season for the sales market.
Yeah, it really starts coming back in early February is when you start seeing a little bit of activity start ramping up.
Yeah.
And by the way, undercover meteorologist again, it's supposed to be snowy, wintry mix tomorrow all day.
Yeah, well,
so
I think the Nino is changing to Nino or the other way around.
Yeah, we have a La Nina. That's the cold. So, cold. Okay, what do we got here? Penalty for days on market.
Could you go over? Yes, let's go over it. Where is it? But there's 2 ways of looking at that. Okay. I don't know whether or not, let me click on chart room. I don't know whether or not you want to do pricing, discount to days on market, guys. Let's do that because we always do pricing penalty. Discount to days on market, generate this chart. This is going to break down the listing discount based on days on market. Let me draw on this. Okay, guys, focus here because otherwise we get lost. Okay, focus here. This is the most recent data kind of over here, right? And you're going to look at less than 30 days. That, boop, 0%. If you got a signed contract and 30 days or less, you basically half above, half below. 31 to 60 days, 2%. 61 to 90 days, 5%. Over 120 days, 9%. Okay, 9%. That's what's going on. If you want a little more data, because this is not filled yet, you go over here. This is not incomplete. You go over here, you take a look at it. Same trend. Okay. Mamdani effect, who is buying, what do you think about this, John? Mamdani effect, who is buying, who will flee and sell. I'm really interested to find out is the discounts for all those deals that surged in October and early November.
Maybe.
Wait 3 months.
Sometimes I feel like politicians are just lucky, for lack of a better word. And so I get the sense that, look, you have Mamdani winning the election at the same time that mortgage rates are finally starting to tick down and buyers are starting to come back. It's just, I don't think they have really anything to do with each other, but I feel like, someone's going to take the credit and it's not going to be the outgoing mayor, right? So it's like, sometimes I think luck has a lot to do with these things.
Maybe. Pricing penalty, guys. Pricing penalty, 9%. Came down a little bit, probably reflecting a little bit of the market starting to turn around just a little bit. It's early. 1% if you price right, 9% if you price wrong. There you go. Denise Rich. Denise Rich was my broker when I bought my property. I love Denise Rich. I was looking forward to a quiet holiday and then received an offer late Wednesday night. I agree with John that there will be contracts signed that were delayed due to holiday. There's always those pipeline, right? Thank you, Denise. Always like to hear from you. There's some activity. There's always some good activity over here. Hopefully you guys close these things out. Close these out. I'm hearing stories of sellers getting good offers and they're not engaging. It kills me. If you get a good offer, engage. Okay.
Well,
John,
I just got to say that, how are you feeling with the market size for 2026? And I'll tell you this, I actually I'm pretty much, I like to say cautiously optimistic, but I'm a little less cautious. I'm pretty much optimistic these days. And I think as Karen, bullseyed it here, Wall Street bonuses are coming in, seeing bankers shopping. It's been an exceptional year for Wall Street. I think bonuses are going to be record level, and that's going to be filtering through to this market. So when is that going to hit? Probably mid-December through March. I think you're going to see a lot of bonus activities. if you plot out when these types of deals trade, right? Condos versus co-ops, condos, which are, usually the bonus, people love to buy a condo, right? That activity is earlier in the year. So I think that's the bonus activity. So hopefully you'll get a lot of condo activities shaping up early in the year, followed by some co-op activity later in May. I am bullish on the spring 2026 year, Noah.
Okay. I'm cautiously optimistic. I'm not going to say bullish. I'm kind of in Noam Newman's camp. I think this market goes sideways for a little while, but if we can have generally higher transaction volume than what we've been going through over the last couple of years, then we can navigate these waters and let the markets do its thing. But there needs to be changes to trigger the sales market. We need to have some changes. We need to have some investors looking at our market differently. Having a days on market debate going on here, Johnny. This is like a Jerry Springer throw the chairs kind of thing. Maybe we're going to produce some kind of fight on here. Maybe the days on market is the hard to tell days on market with the Street Easy new model. I think Street Easy, did they just change it? They just took it out?
I don't pay attention to Street Easy. I find their data
they did
often wrong.
I forgot.
I don't like.
You told me about a sale that was wrong this morning. Was it wrong?
Yeah, I was doing a demo of UrbanDigs to friends and family, and they were like, "Oh, look at my apartment." So I looked at their apartment, and we didn't have the closing price. And like, "Oh, you don't have the closing price." So it does Street Easy, and they had the closing price. So it's like, "Oh, that's interesting." So of course I looked it up, and Street Easy was just wrong. It was the closing price for another apartment. So
people don't understand how hard these data integrity are in New York City and what we had to do to get the system up here. It's tough. Days on market is detrimental to the market, and no one can convince me otherwise. You should all be fighting to have days on market go away. And I think Street Easy, what is it? If you take it off for 30 days, it resets. Okay, that's what they did. They changed the whole reset thing. Interesting debate. I'm not going to chime in here, but it's interesting to see both sides of the coin going.
I'll chime in. I don't think it is a debate. I think days on market is extremely helpful to the market. I think you want to know what days on market is. I think it gives you a lot of insight into both the buy side and the sell side. So why you wouldn't want that piece of information is beyond me. But hey, what can I say? To each his own.
Well, I am in the transparency business myself, so I lean towards John's element on that. At the end of the day, I think consumers need to know what something tried and failed to sell out.
I think days on market tells a story, and I can understand it from a seller's point of view that they feel is detrimental to their listing because it's been on. The reason why it's been on is because it was overpriced. And the story that days on market tells is just as helpful to a seller to understand that they're overpriced as it is to a buyer to understand that, like, oh, okay, maybe there's room to negotiate here. So I think it's an extremely handy metric. Right. That's why if you go to UrbanDigs and you look on one of our listings, we track days on market. We actually do. And we actually put the days on market there. And we have our own filters built in to sort of make sure that it's as accurate as possible. Yeah, we did a good job with that.
Yeah, it was tough to do that. I want to end it with this. It's so nice seeing so many familiar names in the comments. I hope everyone had a good holiday. Grateful to the great brokers I've had the fortune of working with over the years. Thank you, Robin. We feel the exact same way. Everyone's allowed to have different opinions over here. We're allowed to talk. That is all good stuff. Civil conversations, good stuff. Robin, thank you for pointing that out. I love you guys. John, you're great. All right. And on that note, I'm going to close this whole thing out. Okay. And we'll come back next Monday for Macro Monday and discuss more stuff. Okay. Last thing, John, anyone want to talk about last comments or are you good?
Well, I'll give Hillary the last word here. She says, guys, there's so many reasons why things are, how do I show this here? So many reasons why things are on the market. No, it's not about pricing. Pricing is so all over the place. So I will agree to disagree on that one, but I appreciate the insight. I will happily have this conversation and this discussion and this debate about days. It's a great conversation. It's a great conversation because at the end of the day, why are we having this conversation? We're having this conversation to benefit our clients. So they are the beneficiaries of this debate. So let's go.
But I also like to hear the Hillarys of the world. I like to hear the other side of these debates, just to keep an open mind and hear what you have to say. And there are points that are to be made on both sides. So it's a good conversation. Totally. Guys, let's wrap this up. Thank you to John Walkup over there. Thank you, guys. I am Noah Rosenblatt. This has been Macro Monday. Hope to see you guys on tomorrow and Thursday's workshops. Take care, everybody.
Thanks, everybody.